My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Noel Smith. We're going to be talking about option strategies. Noel's quite experienced in that side of the world. So, Noel, for those who are not familiar with you, introduce yourself. Who are you? How'd you get involved, interested in markets, and why the option side in particular?
Sure. So I started in options in 1996, and I was introduced to some people that were trading on the floor of the CBOE, and they asked if I wanted to, participate in what they were doing. I met some people that were in the options game, and I just thought it seemed like it was, really interesting for a variety of reasons. And I started as a floor trader. We started a prop firm in 1996. It was me and my business partner at the time, and we grew that business to backing something north of 100 traders all over the country at the CBOE, the Merck, the Board of Trade, the NYMEX, COMEX, MX, et cetera. And we had market makers really all across everything, and we were the initial seed capital behind Getco, which is a high frequency trading firm that has since kind of morphed into what is now Virtu. And I've done a lot in the space, so it's kind of hard to encapsulate all that in a minute or two. But that's the gist of it.
How has options trading evolved since you first got started? I mean, now we're at the point where it's zero DTE. Who the hell knows what the next innovation is on time frame? But talk about how options trading has changed over time.
Yeah, I'm making this analogy up as I'm talking, but it kind of I'm not single, but it reminds me of what I would think it would be like to be dating back in the day versus dating now. A lot of the fundamental ideas are the same. So, in other words, if you are making markets electronically, some of the trade structures and ideas that work now pretty much did work back then. The mechanics, of course, are different. There is a crowd, and you would enter a trade via voice or whatever else. But the planning, the execution, the way to read the paper, the way to read the market, it's more similar than it is different. I would say, and this is controversial, that a lot of people think that electronification is better for the public. I actually think it's worse, since there is a sense of accountability and some sense of human guilt if you're not there in a crowd that you don't get when you're at a screen and you just pull all your quotes or do something that is totally anonymous, kind of like Twitter. Is something that you would say on Twitter a lot of people wouldn't say to your face, and it's kind of a similar vibe.
I can speak to that very much so, especially given the last several days of insanity on Twitter. Okay, let's talk about just we're going to get into all kinds of nuances as far as options and the current environment, but I want to hear your thoughts on volatility, because it's hard to talk about options without factoring in volatility, and especially the way volatility played out last year. Maybe set the stage for the audience first as far as how do you think about volatility? How do you, at your firm, manage through volatility? And talk about the differences between last year and sort of a more traditional bear market.
Sure. So, a question that you didn't ask is, why do I care about volatility? I don't really have a particular axe to grind in the vol space any more than I would bonds or gold or I don't know, whatever you want. To me, it's just more of a way to kind of figure out what is a probability zone, and I find that to be more useful than saying Tesla goes up because Elon Musk is cool or doing something the opposite of that. I really have no feel for that kind of stuff. I've heard innumerable strong arguments for stocks that should go up that don't go up, and vice versa. Stocks that are terrible that never go down. So I find that line of reasoning to be more difficult to be sustainable than the volatility space. So now on to your actual question: 2022 versus normal. I lost money in my hedges in 2022. It's not like it's a public thing, but it's certainly not private, since I just talked about it, which is a very weird thing for me. I've actually never lost money being long vol when the market's down. So that was a very eye-opening thing, because at the beginning of 2022, almost to the day, we top ticked a lot of our risk-off measurements. And so, very beginning of January, we took a lot of our Delta One instruments and took them to the sidelines. And we kind of sat back and said, hey, we got a bunch of puts in inventory, and we're just going to let those ride, and we're just going to have an amazing 2022. And that failed. And the reason it failed is several fold, but I like to talk in analogies because I find that to be simplest. But imagine you're playing, cards with a bunch of other people, and there's a handful of suckers at the table, and there's a handful of pros at the table. Well, a lot of the suckers got kind of wiped out in COVID. So what ended up happening was the only people that you were able to trade with and for the beginning of 2022 are a lot of the people that were pros, still in the game because they're very good traders. And a lot of the vol was priced very accurately. So consequently, the variance that you need in order to make money being long volatility wasn't there. And the phenomena of the market goes down and crashes up, which is the inverse of normally what would happen in a normal year, was I think a main driver of that lack of profitability for hedges or downside out of the money, put structures or similar, out of the money call structures in VIX or whatever. That's the reason. I think that's the core reason that a lot of those trades didn't work.
Yeah, and it's hard to really express that that frustration properly. Certainly on FinTwit. I mean, I've made the argument that the same dynamic you probably suffered through was related to the same dynamic. So all the hedges, not just each options, but even the asset classes that would benefit from heightened volatility, didn't at all, right? Which made it hard to not only manage through, but even think about how do you, or should you even factor in a repeat of that. So when you're in these kind of abnormal periods, do you say to yourself and to your colleagues when you look at your strategy, this is something we should consider as a possibility going forward, and we have to adapt or change the way our models work, or do you just chalk it up to it's an anomaly, it's probably not going to repeat again, let's move forward?
That's the exact question that we went through. So we tortured the data and we tried to figure out, okay, is this a new regime? Is this a one-off data? Do we want to curve fit all of our back data to make this, a more of a significant event, and or some variant in the middle of all of that? And if you think about what would have worked in 2022, it's basically just like a buy right on its head, which is to say a buy right, you're long the instrument and you're short some kind of out of the money call. In 2022, you should be short the instrument and short some kind of out of the money put, that's why I say a buy right kind of standing on its head. And what we decided to do was, let me give some context. In COVID, the hedging structures that we had worked phenomenally well. We made an extremely good return. We had similar structures coming into 2022 and they failed for very different reasons. So what we elected to do roughly in June of 2022 was mute some of those ideas, make them less profitable and less painful. So the cuts both ways, right? And we decided that the data in its full spectrum was more powerful than what is a one-off thing in the backdrop of an increasing interest rate environment, increasing inflation environment. And we just thought that some of the things were different, but not enough of them. I don't think puts are broken, not at all. It's impossible for them to be broken for more than a second or two. But we do take all that into consideration, and we did change our strategy somewhat to fit that environment. So it's kind of a blended answer.
Okay, and maybe for the audience, talk about what exactly kind of your core strategy is. What is it that you guys do that's maybe different from others? I always go back to every strategy has a certain cycle that favors it. Last year may not have favored it as you would have hoped, but just talk through that dynamic for a bit.
You touched on it. So consider the context yet again. So I am 53 and I've been trading all of my adult life. So as somebody who runs a prop firm, I worked at 440 South LaSalle, which is the exchange building in Chicago. So what that means is that people will find out if you're being, if you're having a good year, you're making money or something like that. So we were making money making markets and options. And then what happens is a guy down the hall working at some other prop firm kind of wanders into your office and says something like, hey, I'm an amazing beans trader at Optiver or Susquehanna or something like that. And I either quit or got fired, and I want to come trade beans for you. And so this individual convinces you that their bean strategy is a good strategy, and you give them money to back them, and then you are in the bean business all of a sudden. So over many, many years and countless conversations like this, I've come to learn a lot about different strategies. And like what you just said is every kind of dog has its day. And our business isn't any one trade. Our business is really replicating what we think are the best practices from prop trading in Chicago, which is some of the IP and ideas that you get from market making, some of the ideas and IP that you get from market taking, and then some macro structures in addition to that. So what we really have are really 4.5, the 0.5 being macro, different strategies that we use, typically with options, but also can be reflected in Delta One instruments. And we combine those in such a way where we feel the environment is just most favorable for that idea.
You've used that term Delta One quite a bit. Let's define for the audience what you mean by delta one.
Soccer futures, something that moves one for one with the thing that it's supposed to represent. So if you buy one share of SPY, it goes up $1, you make $1. Sure. Consider volatility as a deviation in variance. So think about something that's happening to you relative to what you expected to happen to you. So imagine you're home at night, you're sleeping like any other night, it's Tuesday, and somebody breaks into your house and smacks you across the face while you're sleeping. That is extremely shocking. So you are not expecting that. You are awake now and you are frightened. Now, the next 5 seconds, you identified that you have a stranger in your room and you don't know why, and that guy has just smacked you. So he aims to do some kind of violence, and you're very excited. But the jump in volatility is less after you've awoke and stood up than it is when you were sleeping and smacked into being awake. So what I'm saying is that, like in 2020, yeah, there were some signs the market was going to turn or whatever else. But the COVID shock was extremely shocking to a lot of people. We had a 6-month future VIX future at roughly 17, 18, which was not that big of a deal. And then coming into 2022, you had a 6-month future in the VIX, hence something like 26. So at that point, you're already standing up. You're already excited. The future in time is already saying something big is expected. So that your ability to make money is a function of the base effects of what's expected and already priced into those options. So at a VIX of 26, it's much harder for it to double or treble than it is if VIX is at 15 or 17. And that's part of the reason that even though things did happen that people expected, the problem is they were expected.
I want to go to Sumblegate, your website on convex asset management, and you mentioned that you're not a tail risk fund, so we'll define what tail risk for the audience. I've used that term quite a bit here on Twitter, but you mentioned that your focus is on low correlation. Now, I will tell you, I am personally quite cynical of that term, especially in the alternative space, because if somebody claim they're a long short manager, but their correlation really just matches that of the consumer staples ETF, right? As an example.
Sure.
How do you, first of all, how do you even go about constructing what is truly low correlation? Because let's face it, you want correlation when things are going up. You want low correlation when things are going down. You don't want necessarily low correlation at all times if you're in a raging bull market.
Absolutely. So, and by the way, anybody who's listening, and Michael, this goes for you as well, feel free to hammer me on anything. I'm comfortable within my little subject matter. So, pointed questions don't bother me. So, correlation. We construct our own correlation models. We have, what is the implied correlation of the marketplace? What is the implied correlation of our book? What is the realized correlation of what's been happening in various time slices and whatever? And that's just within the S&P 500. And now if you want to look at a correlation of, beans to boats and, that relative to water jugs, they all have some kind of correlation, but, that's not obvious to me, at least, what those are. So what we try to figure out is what are historical correlations, but where the trade really lies is where do we think they will change in the future? So if you have a correlation of, stocks and bonds that are, 0.85 negative, and then you think that in an inflationary environment, they might go 0.45 positive, well, that's a trade. And by the way, probably one of the biggest hedge funds in the world, that's where a lot of their alpha came from in 2022, is just getting that trade right, which is, this is not the trade, but in essence, long Dow, short arc, that kind of an idea. So that's what I mean by the macro standpoint. So not what is the correlation now, but what will the correlation rate of change be in a variety of asset classes, and where do we think we can capture asymmetric alpha? And that sounds like such a nonsense phrase, but that's what options are really all about, right? Which is I'm going to lose X, but I might make 5X, or I'm going to lose 5X and make X, but my probability is 6 or 7X, 6 or 7Y. In other words, you're betting on the favorite horse, and you don't really have that great of odds to win, but your favorite horse is favored for a reason, because he's probably going to win. If you buy a 99 delta option, that option will probably be, fine. It's almost the same as just buying the stock, but it's also not going to pay you that much. That's what I mean by, some kind of asymmetry there. So the correlation, it's really about the rate of change of the correlations and where do we think they will be in the future, some kind of a forward projection, as opposed to just taking a snapshot in time now.
And how do you model that out? Are you looking at different historical economic cycles? What correlations, it's like people always reference correlations, but to your point, I say this myself too. It's like correlations. Everything correlates until it doesn't correlate, right? It's
Right.
like, all right, so Bitcoin's correlated to the Nasdaq now until at some point it stops correlating to the Nasdaq. What helps you determine where that change kicks in, and then how does causation factor into that?
So everything is connected, right? If you have earlobe disease, eventually it kills your toe. Those things, and what is the rate of change in that stuff? What is the speed of that infection? So what we try to do is we try to figure out, where is correlation now? Where do we think it's going to be? And there is a finger in the air in that calculation. There's a finger in the air on all this stuff, and that's like the dirty little thing about investing that I don't think a lot of people believe. And I've peeked under the skirt of almost every major firm out there, and I know kind of what they do. And even HFT firms, which are the most agnostic you're going to find, still have some risk at any one given time. And that risk is just something they have to accept. So the correlation that we're looking at is a forward projection of where things are relative to where they've been, where we think it will go in some kind of an event. And we also then strike our puts or calls and VIX as a percentage where we think that correlation might be. So if you look at implied correlation now at 36, and we think it might go to 66. So say, for instance, Apple says the world's going to fall apart. Elon, dies tonight during the earnings call and all this other stuff. And we go to 3,200 on the S&P 500. Where do we think correlation will go? Do we think it'll go to 99, or do we think it'll go to 89? I have no idea. I have no idea which one of those two numbers is correct. But what we will also do is we will model and strike our puts, our hedges against that, so that our risk is always known. So that if we go to nuclear Armageddon tomorrow, that's clearly bad news for the planet, but it's not necessarily bad news for our book.
Right. And actually, I'm glad you mentioned that point about the kind of finger in the air point. It's like, people seem to think that even if you're quantitative, that it's a perfect science, but there's always a degree of when do you launch your quantitative approach, and that is kind of a finger in the air because there's a cycle aspect to doing that.
That's luck. Right. And there's more luck to this than a lot of people that have been successful really want to admit to. I think that there is just something to be said for, like, when do you show up, when do you add, and when do you take away from your risk, and that has a lot to do with your P&L.
Yeah, and it's like I've so this is kind of a conversation that's very relevant to me, and that's what the approach is designed for. And the luck component, I think, is really intriguing and interesting, but also it's unique, I think, in the asset management industry, in that you often see a lot of funds come out at the top of a cycle, right? And I say that because what do issuers want to do? They want to gather assets. They want to raise assets. What's the best way to raise assets in something that's performing? Well, if something's already performing, it could already be at the turn, in which case they launch that product, and then suddenly the product's not working because the strategy wasn't designed to not enter the new cycle anyway, right? So the luck component is interesting. As you've gone back and looked at your own career, you talk about the prop trading side and the type of strategies that you've run. What were some of the cycles that were maybe bad luck in terms of particular approaches that you would execute on?
Well, options are the breeding ground for thieves and scumbags. So what I learned pretty early on is that if they're
that sounds like FinTwit, my friend. That's not just
so. Yeah, I mean, I don't know if anybody has ever really looked at my Twitter, but I'm very new to Twitter. I've deliberately been anonymous my entire life. Like, even all of my social media is brand new, and the reason is because I haven't ever accepted outside money. And as a result, I think that, having a public presence where you're involved in finance and money and things like that just puts a weird little target on your back. And now that I do take outside money, I've launched a hedge fund. It's almost weird that I don't have a public presence. So that's why I've elected to do that. But if you look at my Twitter or whatever else, I mean, I'm just starting it. And, I have like 2,000 followers or something. It's very small. But it is me. And I really do try to, chime in with something that is, hopefully a little bit interesting. So going back to your question, there's just countless lessons. We could talk about this for hours, but options typically are where people get the most leverage, and you're going to find the most insider trading. And that also gives you a lot of information. You can learn a lot about stuff, specifically like biotechs, which is like the only category of stocks I don't trade. They're just so cheaty. Biotech stocks, because they're so binary. You have a $50 stock, and if your drug is approved, it goes to 300. If it doesn't get approved, then it goes to 2. And so what happens is people come in and buy just gobs of options that will reflect one side of the page or the other. And the even more confusing part of it is volatility will reflect this paper. And then if you're just long vol all the time, the straddle goes from 200 down to 2, and you can't be long vol or short vol unless you kind of know what's going to happen. And it's a very difficult trade. And you have a lot of medical professionals and scientists that express their opinion in the options market, and it's very difficult to outsmart them because they either have inside information or they have the quality and the timing of their information is superior to yours. So I don't usually trade those. But in terms of cycles, it's hard to even know where to go with the question because I could talk about this for hours. I mean, there's just so much to know about.
Well, but let's
trading
talk
options.
Yeah, no, but okay, but well, maybe we'll go with where we've been, which you talked about last year, to where we are now, kind of because you presumably, even though you're trying to obviously create this kind of non-correlated, low correlated return stream, you still have to be aware of the macro because the macro also drives correlation changes. To your point.
Yep.
So how do you think about where we are in the current environment, in the current cycle, and how does that filter through into actual executions across different strategies you're running?
Okay, so this is something that is probably bad for our podcast, but I have been listening to and reading other people's work, my entire life, and I've been, convinced of things that are wrong, and I have also been, dissuaded by ideas that ended up being right. The problem I have with macro and macro forecasting is you are usually in consensus and also right, but there's no trade there. So in order for you to make money, you have to be out of consensus and then also exceed the variance of whatever's out there. So in other words,
Please say that again. I love that because that you're so spot on. It kills me how people don't understand that 99% of the macro shit that you hear cannot be executed on.
Where's the trade? I don't really care what your opinion is. And I don't mean you, Michael. I mean you, a person I'm talking with or writing with. You have to have a trade. Where is the trade? What are you going to do? Yeah, puts are cheap. Okay, fine. How many are you going to buy? Well, I don't want to buy that many. Well, that's why. Where is the trade? So if you think that inflation is going to go from 9.1%, it's going to hover around 4 for a while, and the Fed Fund futures is reflecting that until some point in late summer, and you have this opinion. Okay, great. What's your trade? Well, I'm going to buy Fed Fund futures. Well, that's already priced in. There's no money to be made there. There is no alpha. So that is why I don't pontificate on macro that often. Of course, I'm aware of everything I can as a human being. But I often find it to be in consensus and there is no trade. In order for me to be out of consensus and continuously produce alpha, I have to be different than everybody else and right a lot. And that's pretty difficult because we all look at the same macro data. We all get the same CPI release. We all get the same non-farm payrolls. We all get the same Powell speech, et cetera. So you have to try to figure out, well, what did Powell say that I'm going to go out and bet against what everybody else thinks? And I think that's a very hard thing to do.
Yeah, and what I would argue that the macro can help with is the likelihood of getting whipsawed in a particular opportunity set, right? So if you're in a recession, deflationary scare, you're less likely to get whipsawed trying to trade treasuries, no matter what your signal is, right? Yes. So to me, it's more about thinking about it from the standpoint of false positives, right? From a trading perspective, and what you're executing your signals on in the macro cycle that you're on.
That's where options can be quite useful. So going back to the floor analogy, say you were on vacation for a week and you walk back into the trading pit and everybody is short Microsoft options because that's what the paper has given them. But you, because you've been on vacation for a week, do not have a position in Microsoft. So now your ability to either short more, you're starting at a much higher level than everybody else because they've already been participating in this trade. So once you have a greater feel for where the options flow is and where the positioning is on the counterparties, it does give you tradable intelligence, which is to say that, if you wander into the Microsoft crowd after everyone else has been selling the piss out of Microsoft volatility, they sold it from, 30 vol up to 50 now, and they've been tasting pain for 20 vol points. Well, you walk in and you make a market and you start selling 50 and higher. And maybe it goes to 90, that's fine, but you will still not lose anywhere near as much as everybody else if you have that advantage. And that's where understanding where the positioning in the marketplace and understanding the counterparty risks are, the risk of the counterparties is very useful.
Is there ever a time where you say to yourself, for the approaches, you want to turn off the lower correlating type of return stream drivers and go more aggressive because again, going back to convexity and tails, I mean, it's a lot easier to avoid a drawdown after a drawdown's already taken place. So
Yeah,
why not,
of course.
right? So talk about that dynamic, because there is a when you're running a fund by prospectus that's rules based, you can't do anything. But when you're doing a hedge fund like you are, you might have more flexibility and want to actually turn certain parts of the quantitative approach off.
That's exactly what we do. So we have our 4 core strategies, and we don't consider our hedge to be a strategy. So of the 4 strategies, I'm not even including that, because a hedge is, it's fairly mindless, right? You can do it on your iPhone. You go out there and you figure out what puts you want to buy, or put spreads, or whatever structure, or whether it be the VIX or the SPX or some variant, and then you figure out your hedge. But there's really no IP to that. Exactly what you just said is exactly what we do, which is to say, sometimes we have a bond strategy. What we're doing is we're looking at the volatility surface within the 10-year note, and we model that relative to what else is implied by the marketplace. And sometimes those lines will lie right on top of each other, and sometimes there's discord. And when there is a kink above the implied surface, we want to smash that down. And when there's a valley below that volatility surface, we want to buy that up so that there's some kind of a volatility agreement. And then we tend to spread that off somewhere else in the term structure. But in 2022, we didn't really make or lose any money in that trade because bond vol was so high and so out of sample. You cannot really give me a quantitative argument as to why you would do that. Now, I know plenty of guys that made money trading bonds in 2022, but it was really more shooting from the hip ideas than it was saying, okay, here's my data set, going back to 1982, and I'm going to quantitatively give you a reason that you need to be short bonds. I would say, okay, even if you...
Right, you can't determine probabilities when there's no probabilities in the data set for
what. Right, and that's exactly the problem, and that's frankly why we also have jobs. Is because if everything was exactly codifiable and you could just execute a line of code, then there would be no need for humans, but then that would also cycle right back into the need for humans. So the reason that we didn't make or lose money in our bond trade is because bond vol was so high, and which is also one of the reasons that we all lost money in our puts, because bond vol was high, we thought that equity volatility would increase more than it did. So that was a false positive for us. But I talked about how I lost money in our hedges, but I didn't talk about what we did make money in, and that was our correlation trading. Our correlation trading was phenomenally profitable in 2022. But that's a much more difficult trade to execute, and frankly, probably more expensive than a lot of people can afford, because the trading costs are, they're voluminous. You trade a lot and you do a lot of different things. So,
and just be honest, when you say correlation trading, you're talking about like stat R, pairs trading. What does that mean, correlation trading?
When we do a correlation bet, what we typically are doing is we are selling volatility within the S&P 500, and then we are buying usually the top 100 names that we kind of cherry pick, where we think volatility is representative but low. So we try to buy volatility where we think it's low, and then within the S&P 500, and then we do sell volatility in the S&P, index, and that spread is where we try to gain some alpha. And that trade was it's probably one of the best years ever for that trade.
I'm curious. I understand you wanted to be more on the private side, and that's why you went the hedge fund route. But is there any reasoning as to why you wouldn't want to go more public now that you're getting more out there, launching your own ETF or mutual fund or whatever it be? I'm just I think you and I would both agree that the hedge fund space has been in decline in general for a while, largely because alpha's been hard to get, and a lot of the big names have retired. You can argue, but why that vehicle of choice?
Everything that we do is totally common sense. So as a prop firm, it's not unreasonable to make something like 100%, plus or minus 50%, so 50 to 150% on your risk a year. And that risk is usually connoted as haircut. So, if your haircut is 20 million, is it unreasonable that you make 15? No, it's not. Is it unreasonable that you make 40? No, it's not. Those numbers are completely within realm. Versus the hedge fund space, you go out there and you try to raise $1 trillion, and then you make your 9% and you clip your coupons. So as somebody who has been on the front lines of both prop and hedge funds, I have friends that own hedge funds and have been phenomenally successful with no IP. I'm just sitting there like, okay, I can build a better mousetrap. I can do something that is unique and will return in excess of many of my peers. And I also can take in more money than I can do in prop. Prop trading is usually a middle 8 to 9 figure proposition. You can't trade really 10 figures. It's a lot of money to trade prop. But in the hedge fund space, you can take $1 billion pretty easily. And like if you and I decide to just create our own fund, we can do that with $10 million, and maybe we go out and make 10 million. We split it half, and that's that. But in the hedge fund space, you can go out there and raise $1 billion, and maybe you can make 100 million or something like that, and then we take our pro rata, which frankly the math isn't that different. But then you can scale, and there also is a smoothing effect on my individual P&L. And because I'm from the volatility community in Chicago, I literally kind of came up in the floor, and I know a lot of the players in the space. Not too many people are doing what I'm doing, and so the feedback I'm continuously getting is, "Wow, nobody else is doing that. Let's dig a little deeper." And that's why I think I have a business as opposed to just a trade. It's a function of interest rates. So interest rates and inflation. So what you're looking at is an inflationary environment, like probably nobody on this call, including me, is old enough to have traded anything. Right? I'm old enough to remember inflation, but I'm not old enough to have traded it. I remember my bank account was like 18% or something like that, which is nuts. But when you're a kid, it could be 180%. You have no idea. But the interest rate is the price of money. So you have the cost of goods and services, corn, wheat, gold, whatever. And then you have the cost of money, which is, how much do you need to pay somebody in interest to go buy a house or, get a small business loan or something like that. So, and the volatility of interest rates also affects the volatility of stock. So if we think about, say there's me and my twin, Noel 1 and Noel 2. We both have the same parents. We both have the same, everything, same job. We both make, 100 grand a year, and we both, have been doing this for 5 years or whatever else. But Noel number 2 has, a high credit score and a rich dad. Noel number 2 will be less volatile than Noel number 1 because he has access to money, access to credit, and his ability to not make difficult and painful financial decisions at nodes of inflection it's a much lower probability. So as you see interest rates start to creep up, they go up dramatically, and the volatility of the things that they are associated with, which is to say that credit and debt are very related, the volatility of both those instruments goes up. But to the exact point of your question, which is why is VIX not as responsive as it's been in the past? It is a function of base effects. Where was the VIX relative to where the VIX has been coming out of this, and who is trading the VIX? Going back to my earlier analogy about there's only sharks left at the table. When you're trading only with professional people, and there's not as many VAR swap sellers or people out there trying to sell VXX or these other ideas that work for 10 years and blow you out in year 11, a lot of those guys got just ruined. So what is remaining are people that are much more prodigious with their risk, and they're not taking these same types of risks, which also bleeds into the phenomenon of short dated or zero date options. It's all kind of intermingled, which is to say that people can participate in a rally, but if the market does go down 9% tomorrow, they're not going to get the full exposure of a loss of 9%. They're going to lose significantly less. And those two things, in my mind, are very related. It's a simple question, and I don't have really great answers. I know why people are doing it. You can get different margin exposure intraday than you can if you hold that risk overnight. So if you want to go out and buy, 1,000 SPX calls, intraday, and then close them out before you have to send that information to your prime broker and your OCC, it's pretty different than if you just keep them overnight or for the next week or whatever else. And it also is changing the way a lot of people model volatility. A lot of people like to focus on, VIX, which is a 30-day variance swap or something like that. And if you're looking at that as your vol barometer or oscillator, you're not going to get a full snapshot of what's going on. These moves will be probably not as punishing, because if you think about when the market goes down, why does it continue to go down? Again, this is a lesson learned from the pit. Guys that are just out of money, they have to exit the position for whatever reason. They know it's a sucky trade, but they're going to do it anyway, because if they don't, they will be homeless. And that type of pressure and logic isn't there if you have a bunch of little wingy calls. You've made your $100,000 bet or whatever, and if it doesn't work out, you've lost 100 grand, and that's one bip of your capital, and that's not a big deal. And I think a lot of people can see the same macro data that we've already discussed and think that, the S&P probably should be at 3,200, but they also don't want to miss the party, the right tail. And what they're doing is they're trying to express those bullish desires to be a participant without all of the pain of riding the index back down to where fair value might be, based on, discounted cash flows of, what is the PE of the S&P 500, 15 here or 17? I don't know. But I think that is a root cause of the phenomena. And I don't think it's retail. Like I've read on Twitter or whatever else that it's like, dudes in their basement out there buying, 5-cent calls or whatever else. I don't think it's that at all. If you look at the volume and the way it's being traded, it's far in excess of that. I think it's mainly pros and market makers interfacing.
Yeah, I was going to ask that question because I've heard a lot of people in the know say, no, it's institutional money. Don't buy the retail narrative.
No, I don't think that's true at all. I mean, I have friends that are market makers, at the biggest market making firms. And so I don't have to really guess about some of this stuff. They're not going to tell me, their trade secrets or whatever else, but I mean, I do know in general what's going on. And a lot of the paper is people that don't have a lot of Delta One risk on that still want to be long. But if the market does go down in a hurry, they don't want to get clipped. That's the simplest logic I guess I can come up with.
So I named the space purposely the Age of Turbulence, which, is basically kind of ripping off Greenspan's book, right? Every age of turbulence needs an age of moderation before it. You can call it the Minsky moment. You can call it the sort of classic dynamic of, hidden buildup of risks with leverage and then a black swan, all this stuff. It's all the same concept. And you hit on the term tail on the right side. I've made this point before that QE3 was really remarkable in that it really cut off the left tail for U.S. equities, in particular large caps, right? Ever since late 2012, early 2013, since then, zero interest rate policy, QE3, all this stuff, you really didn't have sort of the more classic fat left tail in a distribution pattern, which made it hard, I would argue, for any kind of real historical volatility VIX type strategy to really stand out. Although you had the volatility internationally, you didn't have it on the domestic side. Assuming that we're not going to go back to QE, which we can debate, assuming that we're not going to go back to zero interest rate policy, which we can debate, does any of that result in your mind new strategies to think through or to turn on or to implement? Because I do believe that the next 10 years are going to look very different than last time.
So as you said, like we can debate. I don't know any more than anybody else. And you can put together what I think is a strong argument for one or the other. I tweeted out something that I want to fulfill, which is to say I wanted to put out something that's actionable. So let me give you some facts, and then I'll give you some speculation. The fact is that we made very good money in correlation trading, in the last, 16 months. I speculate that trades like that and similar trades, specifically well-timed and well-placed iron condor strategies, will probably continue to make money. Why do I think that? Because if S&P rallies, then the Fed might come out and say, well, even with our steep ascension of interest rates, we still have not broken the market. Therefore, we have to say something that's very hawkish, and therefore the market goes down. Then the market goes down, and you say, okay, well, I've got to get Joe Biden or whomever else reelected, or I want to become the next Fed chairman, so I have to be really dovish. And the market goes down to 3,000 or 3,200, and we have to be really dovish. What ends up happening is you have this ping pong effect, and I think that is an environment where there's enough volatility and uncertainty through several metrics, where a condor-like strategy, strangles condors, will continue to make money. Because I think that if the market goes to 5,000, where you might get blown out of your condor, there's just the precondition for that to happen is a full reversal on the Fed's part. And then the concomitant inflation that accompanies that decision will necessarily make them reverse that same decision. That's why I think the idea that a condor strategy, which has been working, will continue to work for the foreseeable future. When will it stop working? Which is what I would want to know. It will work even if the Fed backs off of their strategy for a while. So if the Fed says, you know what, I was just kidding, and we take interest rates back down a couple clicks, and then we sit for a while and VIX goes to 10 or 12, then I would back off the strategy. But while we have VIX hovering in the neighborhood of 20, give or take, these strategies are working, and I think will continue to work in almost any permutation over the next year, give or take.
And that's going to be wildly frustrating for buy and hold investors, right? Because what you're talking about there is basically whack-a-mole, right? So the market goes
Yep.
up, the Fed comes in, tries to hit it down, and then
Yep.
it comes back in, right? So you have this kind of very tight, what looks like a volatile, frustrating range that nobody's that's holding stocks would benefit from.
Yes, exactly. So, in a condor type strategy, what you're really doing is you're selling Vega, and you are, really trying to have time on your side and indecision on your side on the market's part. And that strategy is something that I continue to think will be successful. And, that's something I wanted to say, because, I said whenever I speak publicly, I want to provide something that's useful when the listener walks away like, okay, this guy gave me an idea. Now I'm going to go do my own homework and figure out if it's suitable for me.
Do you factor anything around like cycles, like presidential cycle, and that? So I say that because I think the history is pretty overwhelming that the third year of a presidential cycle tends to be the strongest of the 4-year cycle. Now, granted, everything's off with the way COVID threw the economy into a tailspin, but is any of that sort of historical context there, or is it more just about what's happening in the here and now?
That is too slow moving for me to take any real action on. So the Congress and the Senate being different now than the executive office, and that being tied into where Powell, who is kind of a Republican but also a political animal, is going to make his decisions, is too amorphous for me to make a trade. Again, we can talk about this over beers type of an idea where we can go to the ins and outs of it. But in terms of where do I want to make a trade, I would gravitate back toward the condor idea or a strangle idea, because I really do think that if we rally too much, the Fed will be hawkish, and if we crash too much, the Fed will be dovish, and that prints money for a defined risk strategy like a condor.
Sort of, which is a strange new world if that's the case. I don't necessarily disagree that that's a possibility, right? The idea that the Fed manipulates the stock market to go nowhere.
I think that I don't think there is conspiracies amongst people. I think that there are groups of people that may have a collective self-interest, which is maybe a nuanced way of saying
That
conspiracy.
sounds like conspiracy,
Right. But it's say for instance, you want your business to do well, and I want my business to do well. So we decided to do a Twitter Spaces together. And while there's no collusion whatsoever between us, we both want the same thing, which is to somehow monetize our knowledge and information. That's not a conspiracy, but we both want the same thing. And that's what I mean by the politics of the Fed and the Fed themselves might be working in some kind of a loose collusion where the Fed is motivated by being in the good graces of the government.
I see that on your timeline you've mentioned put call ratios, and I see a lot of people making the case that whereas you might look at put call ratios in the past as contrarian sentiment indicators, it's hard to really know if that's real anymore because zero DTE. Going back to that part of the conversation, to the extent that options were historically used as sentiment plays to try to fade for contrarianism, do you think that signaling power has gone away over time, or can options still be used as a way of identifying where the crowd is most extreme?
The answer is nuanced. So the phenomena that you see in put call ratio typically happens on a Wednesday, and the reason that it happens on Wednesday is because participants that have large positions, specifically in some of these higher priced names that have been around for a long time, especially in January, what they're doing is they're coming in and they're trying to collect the short rebate, and they're gaming that interest rate out really for a 4-day period. They're doing the trade on Wednesday, and they're trying to collect interest to the following Monday, because the trade settles on Friday and then you collect the weekend. So those aberrant numbers that you see in a put call ratio, something like 2, when it goes just bonkers on a Wednesday, that is an interest rate game. It has nothing to do with the sentiment of the name. Like if you see someone out there trading a ton of Amazon puts, there's absolutely nothing to do with where those people think Amazon's going to go.
Yeah, that's hard. That nuance is hard to get across on Twitter, because you end up seeing a lot of people retweeting and liking things that maybe when you dig down a little bit deeper, it doesn't tell you all that much.
You have to just look. So if you see a put call ratio, say the market's going down, right? Say the SPOOs are down, 3 or 4%, and then you see tons of people reaching for 40, 50, or 30, delta puts or whatever else, and the volatility is expanding, the VVIX is going up, and you can just see the term structure of the S&P 500 starting to shift. That's different. That means people really are getting either afraid that they want to profit from the downdraft or whatever, but they're out there, saying that this new volatility is something that I want to get. But if somebody's out there just rolling 40,000 puts that are 99 delta puts in Amazon, there is no signal in there whatsoever, other than interest rates are higher now than they used to be, and we want to collect that short interest rebate. That's the trade.
Other than last year and the sort of, as you said in the beginning, the idea that you lost money on your hedges despite volatility where it was. What talk through to the audience just other years that were maybe abnormal that surprised you? Just do a little war story talk with us for a bit.
Well, I've been trading my own money since LTCM, Russian ruble, Thai baht, fiasco. That was my first lesson in being short volatility because I got my ass kicked, and that was very unfortunate. I also rode Enron from 60 to 0, and it wasn't like I had 5 shares. We had a chunk, and something that's actionable, something that I think that a lot of people could look at is 2008. If you look at VIX and the way 2007, 2008 played out, it didn't just crash all at once. And the idea that nobody knew it was coming is also total nonsense. Everyone knew that houses were fairly overstretched relative to incomes, and that the housing market was very frothy. But the idea of going out there and buying CDS and these different names was much too exotic for most people. So if you went out there and you bought a bunch of puts in the S&P 500, you didn't really make money until things really started to go haywire. So you could maybe cut and paste some of those ideas to what's going on now. This is not an exogenous event, like the housing crisis causing Lehman and Bear and whatever else to blow up. This is more endogenous. This is something that the Fed does have a much larger handle on, and some of those same leverage ratios are not there today. So, do I think we go to 2,500 or whatever? No, I don't. I have no current information to think that. But I also have a book that will make money if that does happen. So I don't want to talk out of both sides of my mouth because I really don't know what's going to happen. But those lessons is that the idea that you are hedged or ready for a crash and then you're just sitting around waiting for that crash to happen, that might be a very painful and expensive lesson. That's why I tend to gravitate towards spreads or things that are defined risk, because if I'm wrong either in direction or time, it's not going to blow me out.
Yeah, no, that makes sense. And by the way, I'm glad you mentioned that point because I always go back to that line: path matters more than prediction. Because you're exactly right. Back then, it's people seem to think that the 0708 housing crisis into the GFC was nobody saw it coming. But you're right; everyone was talking about it back then, but nobody knew
Yeah.
exactly the path with which you will play out. And that's all that goes back to the discussion around macro versus execution. You can identify the endpoint from here to tomorrow, but how you get there is all that matters.
Exactly. And it's just like the .com bubble. I was literally in a pit trading pets.com and other names like that. And people are like, well, nobody thought it was a bubble at the time. Total nonsense. Everyone thought it was a bubble. Everyone knew it was a bubble. But the guy standing next to you that has been long it for the last 3 months is up 8,000%. And you're standing there all sensible and whatnot and poor. So the idea that you wouldn't participate in something that is clearly going on and very busy right in front of you is a total wasted opportunity.
Maybe for the final few minutes here, Noel, just given that your experience, you've dealt with a lot of traders, as you mentioned on the prop trading side. Um, what are some of the things that you find people often get wrong when it comes to strategy development, thinking about options? Talk about that because I think it's often more instructive to know what not to do and how not to think.
So somebody who's backed a lot of guys, I'll tell you that confusing luck and timing for alpha is very dangerous. If you come to me in 2020, 2021 and say, hey, I'm the best lumber trader at Susquehanna. Look at me, my Sharp is 65 and I'm up 8 trillion%. Do you want a job? I'd be like, whoa, those numbers are amazing. Well, here's a job. But now lumber's gone down. What's up today? Or, it's up in 2023 or whatever. But, you can't just look at the data with no context and just think it's a good idea. Same thing we were talking about. People launch ETFs or hedge funds when the market's going up. The same way that people build high rises when the real estate world is hot. You can't use past as prologue without the context that is needed. Is lumber a good trade? It was, a couple of years ago, last year. Is lumber a good trade in 2023? Yeah, sure, a little bit. Will it continue to be? I have no idea. But that doesn't mean anything. All it means is that you have to be able to figure out where is that money coming from? How are you making money in lumber? Is it because you think lumber is going up and you're just long it? Or are you trading lumber versus, palladium, copper, and everything else that's in the building permit cycle? I don't know. I'm making that up. But, there's so much context. And that's one of the main things that people fall for. They chase returns and they don't have any idea as to where those returns are coming from. And are they repeatable? That's, I guess, the main lesson I learned as a boss.
Yeah, no, I'm with you on that. They and and they don't even ask very basic questions. I keep joking. It's like somebody says, "Oh, it's so weird to talk about lumber as a leading indicator." You just said it. It's part of the building permits and housing start cycle. It's like, it's a leading indicator because it has to do with housing. As simple as
Yeah.
that. But most people won't even think from the signal perspective. They'll just say, "Strange. Why would you even think about that?" Whereas, it's always the simplest answer is the one that's probably right as to why it matters for. That's why I have lumber as my right eye. It relates to one of these papers I put out. And everybody here, please make sure you follow Noel Smith. I'm going to take a 5-minute break before doing 2 more spaces here. Again, this will be an edited podcast on all your favorite platforms under Lead Lag Live. First time, Noel, you and I are chatting. I do want to talk to you and pick your brain on some other things after this call, so we'll set up a call here. But thank you, everybody, for joining, and hopefully I'll see you very shortly. Thank you, Noel.
Thanks for having me.
Yeah.